from consolidation. Actually, this question I picked up from your BPP practice script, and it is given in mock exams. Okay, it is within one of your mock exams. I think mock exam one. The question is about consolidation. It says after preparing a draft statement of profit or loss for the year ended 30th September 2005 and adding the current year's draft profit. So you have prepared the draft P&L and the draft profit. Draft profit means the initial working. It might need some adjustment. Before any adjustments required by notes 1 to 3 below to retained earnings. The summarized trial balance of Candy Company as at 30th September 2005. Dates are very important. 30th September 2005. So your year is ending on 30th of September. Okay, 30th September ending means that it is beginning at 1st of October 2004. This is 30th September 2005. So this is trial balance. Both sides of the trial balance are equal. And then it says that equity shares, $1 each share, 20,000 or 20 million because there are 3 zeros here. So it's 20 million retained earnings as at 30th September 2005. So this includes your retained earnings from past, plus it includes your profit for the current year, draft profit, 15.5 million. Proceeds of 6% loan notes, which means you issued some loan notes and you received cash, 30 million. You've got investment properties at fair value, 20 million, land and building at cost, 35 million. There are some note 1 and note 2 for here. Land and building, 35 million, plant and equipment at cost, note 2, 58 million. Now, you know that land and building is given like you have land and building 35 and your accumulated appreciation is 20. So it means that the net book value of land and building is 15 million, okay? Similarly, plant and equipment is 58 million and it has accumulated appreciation of 34 million. So 58 minus 34, it makes me something like 24 million is my net book value of, always remember to subtract to find out the net book value. Then it has got current assets of 68.7 million, current liabilities of 43.4 million, deferred tax, note 2 and note 3, 2.5 million on the credit side. That's a deferred tax liability. Then it has interest paid, note 1. It says interest paid, what you have already paid, 1.8 million. And current tax is appearing on the credit side, which means that that is an over provision, is 1.1 million current tax. Under over provision, you understand from your IS 12 lectures. And then you've got suspense account, 17 million. So something which is unidentified, we have not properly put it into any specific account. It is unidentified, it appears in suspense account. Remember, suspense account never appears in your financial statements, okay? So we will remove the suspense account, either it goes to the balance sheet or income statement, wherever it needs to go. So we have to remove it while preparing financial statements. We don't show suspense in the balance sheet. Okay, so two sides of the trial balance are equal. Now let's start reading the notes together. I just read these numbers. In exams, you should be doing it very quickly. No need to spend a lot of time. I would be spending more time because I'm not doing the question, I'm explaining and then doing. So I definitely will take more time. You have to be much faster than me. Note number 1, the loan note, because if you see that it was given that there are some loan notes. Let me see what are the loan notes, okay? I see that we have here under some liabilities, current liabilities and deferred tax, interest paid, suspense account. Where are the loan notes? I think loan notes were above. Yeah, loan notes were given here, this. And this was given in note 1, okay? So 30 million. What do they say about that? It says that the loan, now remember, when they say that you have this draft financial position, so you know what, when usually you need to do some adjustment. Besides, they tell you that the draft profit, when I saw the word in the question in the beginning, it said draft profit. I immediately understood that some adjustment I need to make. You see here, it says that the draft profit, it says that the draft statement of profit or loss and the draft profit. So it means that this retained earning is not the final number and I need to make adjustments. Maybe the actual profit will be more, maybe less. So we will see what are the adjustments we need to make. So if you see that the loan notes, it says that the loan notes was issued on 1st October 2004, which means beginning of the year. So any interest is for 12 months, okay? Because when you issue loan notes, you pay interest. And you always need to see that for how much period I need to calculate interest. So you are preparing financial statements on 30th September. Loan notes are issued on 1st of October. It means that it is all full 12 months. It is very important to pay attention to the dates. So the loan note was issued on 1st October 2004, first day of the year, and incurred issue cost of 1 million, which were charged to profit or loss. Now that is a wrong treatment actually. The interest of $1.8 million, 30% of 30 million into 6% was paid on 30th September 2005. End of the year, so first day of the year, you received 30 million, you paid out 1 million as issuing cost. Then on the last day of the year, you calculated 30 million into 6% and you paid 1.8 million. The loan is redeemable at 30th September 2009, which means after 5 years, you will redeem it. So it's like you are keeping it at amortized cost, okay? So when you are issuing a loan note for a period of 5 years, how can you put at 1 million in your P&L? Now that is a mistake clearly because this is a loan which is held to maturity under IFRS 9. This is the loan note which should be treated at amortized cost, okay? So because it is for 5-year period, why are you putting 1 million to P&L? It says issue cost for 1 million and you charge it to profit and loss. Charge means that you show it as expense into profit and loss, which is a wrong treatment because it has a 5 years life at a substantial premium. So loan notes will be redeemed at a substantial premium, which means you will have to pay more than 30 million. How much more? We don't know. And we don't need actually now. And because you are going to pay back more money, which makes an effective interest rate of 9% per annum. We always need to know EIR, effective interest rate. This is our finance cost, okay? Always remember, your finance cost is not the coupon. 6% is the coupon rate. This is the interest which you should be giving. You calculate. But in your financial statements, your finance cost is always EIR, effective interest rate, which is 9%. Which means that because if I tell someone that, it is a $100 loan note and I will give you 6%, so I'm giving you $6 here. Then I give you $6 here. Then I give you $6 here. But then at the time of maturity, I pay you $120. So actually my cost is not 6%, my cost is more because there are two things. One, I'm losing 1 million. I'm losing 1 million in my issue cost. Then I'm also giving 20 million or $20, whatever more. So I'm getting less and I'm paying more. So it means that my real interest is not 6%. Real interest is more. And that real interest is called effective interest rate. And we should be calculating our interest expense not based on 6%, but we should be calculating it on 9%. Okay. So this is our first working. We will calculate this thing first note working. You actually in exam can start doing it or you can read it further. Let's read it further. And then we will make calculation one time because now I will give explanation and then I will start doing it. But in exam, this one loan note, this working note number 1 is sufficient to start your calculation of interest expense or loan note calculation. You can start making here if you are in exam because if you read too much, you will get confused. Then it says that, okay, where I am, okay, this is finished. Note number 2. On 1st October 2004, again beginning of the year, the first day of the year, Candy owned two investment properties. The first property had a carrying amount of 15 million and was sold on 1st December for 17 million. So your net book value of this property was 15. You are selling it for 17, sold. So it means that you have 2 million gain, and that 2 million gain is on investment property. The disposal proceeds have been credited to the suspense account. So if you remember the trial balance, we saw suspense account showing 17,000. So that 17,000 is actually that 17 million which is coming. You see from here, so this 17 million in the suspense account, this is actually the disposal proceeds of this investment property. The disposal proceeds have been credited to suspense account. On 31st December 2004, the second property became owner occupied and was transferred to the land and building. So you had two investment properties. One you sold, the other one you start using it. When you start using it, now it is not IS 40 anymore. Investment property, it is not, because it has been using. So you convert it to your IS 16, which is property, plant and equipment, and you start charging depreciation. Okay. The second property became owner occupied and so was transferred to land and building at its fair value of 6 million. Its remaining useful life on 31st December was 20 years. Ignore any deferred tax implication. Now, this is what will happen. The first property was 15. I sell it for 17. I should record a 2 million gain. This is one, like this note for investment property, what it is telling me. The second property is for 6 million, and we are transferring it to our IS 16 PPE, and therefore we should start calculating depreciation. Okay, so this is 6 million. Let me call it like 6,000. Life is 20 years. So this will give me 1 year depreciation. But when did you transfer it? You transfer it on 31st December 2004. Your year beginning is 1st October. So 31st December 2004, which means starting from 1st January, 1st Jan to 30th September. So 9 months depreciation I will take to PNL. 9 months depreciation should be calculated. Is it clear?
Yes, sir. Yes, it's clear,
Now,
sir.
the third thing which we can conclude here, that one property had a net book value of 15, and the second property, they don't tell us net book value. They say fair value. If you see, here it is telling me at a carrying amount. But this property had a fair value of 6 million, which means that there is some revaluation done. 15 million here, 6 million second property, total is 21 million. So two investment properties value at 21 million. How much investment property is shown in the books? 20 million. How much we get after fair value? One we sold, other we made the fair value. So it means that there is a revaluation gain. There is a gain of 1 million as well. Revaluation gain here is also happening on this property. Are we clear? So three adjustments are needed from this investment property thing only. Okay. Then investment property we are finished. Let's read about PPE. The price of property has increased significantly in recent years, and so the directors decided to revalue land and building. Please mute yourself. Somebody is unmute. The directors accepted the report of an independent surveyor who, on 1st October, beginning of the year, valued the land at 8 million and building at 39 million at that date. This revaluation specifically excludes the transferred investment property described above. So this 6 million does not include it. Although the 6 million property is also in PPE, but it is not inside. So this makes me 47 million. My revalued amount is 47 million. The remaining life of these buildings at 1st October was 15 years. This is land. This is building. This 39 million will be depreciated over 15 years. Caddy does not make an annual transfer to retained profit to reflect the realization of the revaluation gain. Annual transfer to retained profit, what does that mean? I'm not going to speak it again a lot because we don't need it here. But the point is, if you remember that, if you have seen the lecture of revaluation, we said that when you make revaluation and the new value, I mean, before property was 100, depreciation was 20. Now property is 150, depreciation maybe is 25. So $5, the difference, this $5 is called extra depreciation. And this extra depreciation, we say debit, revaluation surplus, credit retained earning. We transfer this to the retained earning account. You have seen revaluation video from your CCF3, which is also available on your F7 page. If you have not seen, please see that video. But we don't need to do it because the company, it says that the company does not make. So because it does not make annual transfer, so we don't need to make any adjustment for that. If it had made, then we need it. Anyways, so there is a revaluation gain. Let me see how much is the land and building. Land and building, if I consider, it was 35 million and accumulated depreciation was 20 million. So it looks like that the net book value was 15. Now I'm charging it at 8 plus 39, which is 47. The difference between these two is 32 million is my revaluation gain. And this revaluation gain will have deferred tax implication. And then this value, you did not charge for depreciation. For this year, we will charge depreciation. So I will calculate depreciation on 39 million. This 39 million will be depreciated, land will not be depreciated. And then that investment property 6 million divided by 20 multiplied by 9 divided by 12. This will also come into depreciation. So I will charge the two depreciation and that will be my closing net book value. I'm just explaining so many things that when I start doing, then you don't get confused. So as we are reading these statements, we are trying to make a picture in our mind that what we need to do. And then it says that plant and equipment is depreciated at 12.5% per annum using the reducing balance method. There is no revaluation stuff in plant and equipment, only in land and building. No depreciation has been charged on any non-current asset for the year. So whatever numbers we produced on 30th September, we did not include any depreciation. That's why we have to calculate. Note number 3, a provision of 2.4 million is required for income tax on the profit for the year. So your current tax is 2.4 million. The balance on current tax in the trial balance is the under over provision. 1.1 million was over provision. We can see it in the balance sheet. It appears on the credit side, so I subtracted. In addition to the temporary differences relating to information in note 1 and 2, Candy has further taxable temporary differences relating to information in note 1 and 2. Candy has further taxable temporary differences of 10 million at 30th September. This is your deferred tax. This is 10 million. And then there is some adjustment for that property. If you remember property revaluation, deferred tax adjustment, I'm sure you have seen IS 12 lectures. We subtract that thing. 32 million is revaluation multiplied by the tax rate is, how much is the tax rate? 20%. into 20% and we make adjustment for that. Okay. Now we come back to requirement. Three notes they gave us and we discussed them and we spent almost 20 minutes in discussion. Now it's time to do. Step number A, requirement number A, prepare a schedule of adjustments. Schedule of adjustments required to the retained earnings of Candy Company as at 30th September 2005 as a result of the information given in Note 1 and Note 2 and Note 3. So we start from here. But before you, now I tell you what will happen. So requirement A, you will say that, retained earnings as per question or as per trial balance, you can say whatever, that is 15.5 million. Okay, so I can put it as 15.5 million and let me put here. And after that, I need to make some adjustments. Now, what comes to my mind immediately that this 15.5 million, it will be the loan note adjustment should be here. My investment property adjustment should be here. My PPE adjustment will be here. My tax provision, whatever, should be here. So these are the things which are going to impact my this retained earnings. So let's, and we don't know the numbers. So let's first find out these numbers, that how they are going to impact it. So let's make some calculations here. We'll say that working one, this is for loan notes. Okay, so in loan note, what was happening? If I come back again and if I give you an opportunity to read it, it says that the loan note was issued on 1st October and incurred issue cost of 1 million, which were charged to profit and loss. They put it as an expense 1 million in profit and loss. So what happened that they issued loan notes for 30, 1 million they've spent in expenses. So net amount they got 29 million. So what we should be doing, we should be calculating our interest as 9%. Like I told you that effective interest rate is 9%. And this 9% should be multiplied with 29 million. 30 million is not the case. This is for interest. And for this 1 million, which was issuing cost, they already subtracted it from income statement, which they should not have subtracted. So what I would do, I would say that add back issue cost of loan note. This is my first adjustment. And I will simply add back 1 million. I don't need to do anything else here. For this working, it is, 1 million you need to add back. Then what else is there? Interest calculation. Okay, I would say that issue costs add back to my 1 million. Then interest calculation. Interest calculation. By the way, the question says, okay, just let me read the questions. Prepare a schedule of adjustments to require the retained earnings. Okay. Interest calculation, how I will do. I would say that proceeds, okay, no, loan notes are valuing 30 million. Less issue costs. Issue cost is 1 million. Make a total here. This is my net proceeds. And then I would say interest expense. interest expense I would calculate because it is full 1 year. If they issue it during the year, then you will apportion 4 months, 5 months interest. I will take full interest, 29 into 9%. It is 2610 already paid and recorded because they paid something. How much they paid? They paid this 1.8 million interest paid. So this is paid and recorded. So I just want to see the difference. So minus 1800. So this I would say that 810. So um, balance to be charged to P&L. This loan note, opening value. Opening value of loan note will be 29 million in my balance sheet. I should take it as 29 million. Okay. Then I would say add interest, which is my interest cost is 2610 less interest paid. How much we have paid? We have paid 18, and I would say closing value of loan notes, and we make a total. So this loan note adjustment will come like this. So loan note, so because we are going to show it in two places. So in the balance sheet, your loan note will appear as 29,810 because your opening liability is not 30 million. Opening is always started with the net amount 29. On that 29, that is 9% interest. Out of 9% interest, which is 2610, I add, because this is my liability plus interest which I have to pay minus the interest which I've already paid. This is your amortized cost, and this will go as non-current liability in the balance sheet. You don't have to split it because if you see that it says that no other payments are due until 30th September 2009. So you paid one-time interest and then you will not pay anything for the next 4 years. So all of that will go into my balance sheet as a non-current liability. I don't have to pay interest in next 12 months. So this goes to income balance sheet. When it comes to income statement, so our interest in income statement should be 2.6 million. We just calculated at 9%. 1.8 million we already have recorded. So this 810,000, we should charge it to the income statement. And if we charge it to the income statement, it will decrease. I would say that loan note interest expense adjustment. Okay. And let me put it here. I will call it working one, and this is also working one. And that should decrease my retained earning. So 1 million will increase my profit because this was an expense which we mistakenly recorded before. So we added back to increase profit. And this was the expense which we should have recorded, but we did not record. So now I'm recording this expense. So I'm decreasing my retained earnings. So I'm putting it as a negative. If you have any question, please ask me now.
Sir,
So we did this loan note adjustment. We understand. Then we start our working number two. And working number two is about our, I would call it my PPE, non-current assets. Okay. But I'm just calling it, okay, there are two things, investment property and this thing. So let me call it PPE. I'll make it for PPE separate and investment property separate. Okay. So let me just call it first investment property. So we'd say that first property, net book value 15 million, sold for 17 million. So 2 million, it is revaluation gain. Revaluation. It's not, I'm sorry, because it was investment property. So it is, it is gain on fair value. This is first thing. Second property is and this has already been sold out. Second property is for 6 million, and this is for transfer to PPE on 31st of December. On 31st December. And then I would say depreciation on this property should be charged to P&L, okay? And this is 6 million divided by, I think, 20 years life. It says 20 years life multiplied by 9 divided by 12. So actually this I should put here. And I would say that this is 225 depreciation. Okay. And then I would say that total investment property as per trial balance. I'm just writing too much, okay? It was, I think, given 20 million, if I'm not mistaken. Yeah, 20 million. It is 20 million. Sum of two properties is 15 plus 6, which is 21 million. And that is gain on revaluation. Or you can actually say that, yeah, 1 million. And that is gain on revaluation. This goes there. Then you have your working three. Working three is about your PPE. So if I see that, what is the value? Land and building. Land and building had a value of 35 million. Accumulated depreciation was 20 million. So land and building cost is 35 million. Accumulated depreciation as per trial balance, which is 15 or 20? 20 million. So I can say that our net book value is 15 million. Revalued, and after revaluation, land and building. So when they revalued it, they said that after revaluation, the land becomes 8 million and building become 39 million. So land is 8 million, building is 39 million, total is 47 million. And here I would say revaluation gain. Revaluation gain is 47 million minus 15 million, 32 million. And this is going to impact my deferred tax because I have to calculate deferred tax on that gain. Are you guys clear? Or I'm doing for myself? I'm doing it a little bit faster now because I already have explained you all of these workings before.
Yes, yes, sir, it's clear.
Sir, it's clear.
Okay.
Are we going to charge depreciation on this
Now we are going to
revaluation, fair
charge
value revaluation?
depreciation on building part. Now, when did you revalue? When did you revalue? It's important to know when did you make revaluation. Revaluation
Beginning
was
of the
done on 1st October, which means beginning of the year. So full year depreciation you should calculate. Listen, this land is not going to be depreciated. So depreciation will be only on building part. 39 million. And how much is life? 15 years. Yes? 15 years. So I would say 13 million divided by 15. So this comes here, 39 million divided by 15. Now, please pay attention. Listen, let's suppose that if you had, now it's important to understand, if you had made this revaluation on not on 1st October. Let's suppose you have made a revaluation on 1st of December. Then what you should do? Then you should do like that from previous year, September, October, and October, November, December. So you should take 3 months at old asset price and 9 months at 39 million. So, and I mean, if you have done revaluation in the middle or somewhere, then you should do that after revaluation, the new depreciation, but before revaluation, the old cost in the balance sheet. Am I clear on that? For example, whatever was your old cost, it was, I don't know, maybe it was 35 million, and you should be calculating something within 35, whatever was the land. They did not tell us. Let's suppose they tell us that within 35 the land is, I don't know, 5, and the property is, building is 30, so we should calculate depreciation on this for the first part and then after that part. But this question is simple. They say that full 1 year depreciation, so full 1 year depreciation on the new rate. And then I also have depreciation on investment property transferred. Okay, because some investment property I also transferred. How much of that depreciation? That was this much, 225. I can show this calculation here, this one, like here. Okay, um, let me just make it like, I'll make it depreciation of investment property transferred, and this I will show here like this. So this is 2600 and this, and then I take my total. This is my total depreciation. And then this total depreciation, and I would say that net book value of PPE, which is 47 minus 2825. That goes to the balance sheet as my net book value, 44 million or whatever. Is it clear?
Yes, sir, it's clear. Yes.
Then I have plant and equipment also. What is plant and machinery? This is actually not PPE. This is of land and building, because within PPE, plant and machinery will also come. So what is my plant and machinery? There is no information about plant and machine. There is no revaluation. It only says plant and equipment is depreciated at 12% per annum using the reducing balance method. 12.5 at reducing balance. So let's first see plant and machinery. Let me just drag it a little bit down so that we don't have to scroll much. So if I see the statement, how much is my plant and machinery at cost? So plant and machinery, I would say cost less accumulated depreciation, and book value at beginning of the year. So plant and machinery was 58,500 and depreciation is 34,500. 58,500, 34,500. So I put it as 58,500 minus 34,500. And I make a total. So this was my cost at the beginning of the year. And then I depreciate depreciation for the year 2005, which is 12.5%, because they say reducing balance, and that's why I calculated cost, because the question says that plant and machinery is depreciated at reducing balance method. Reducing balance method. Reducing balance method means 12.5% of the book value. You don't take 12.5 of this. You don't take it for the cost. take it for the book value. This is called your, how to say, reducing balance. And then I would say net book value at the end of the year. And then what do I have? I make a total, it gives me 21 million. So I've got 21 million here. Any questions, please ask.
Sir, the depreciation of investment property is for 3 months, not 9 months.
I took it for 9 months, my friend.
But it's only for 3 months, October, November, and December. It is transferred.
No, it was transferred on 31st of December. So January 2005, January, February, March, April, May, June, July, August, September.
Okay, sir. Okay. Okay, sir.
Because it was it was before investment property, now it is PPE. So when it becomes PPE, you start charging depreciation. So it becomes PPE for how to say,
For 3 months.
for 9 months.
Okay, for 9 months.
See,
Okay.
1st October 2004, and we are ending on 30th September 2005. So here on this date, like on 31st of December 2004, it was investment property here, and you transfer it to now PPE. So when it become PPE, I calculated depreciation for this period, which is 9 months. And now it is no more investment property. It is also PPE now.
Okay, sir. Okay.
Okay. So if I have to calculate my PPE now, how much it is now? I've got here, but it becomes PPE. So I have now my land and building. So I'm seeing now net book values. Okay. Let's do it like this: land and building. And then I have my, investment property, which is now in land and building. So I'm just showing you for the sake of clarity. And I have my plant and machinery. So this becomes how much? This was 47 million. So I have my land and building now. How much is my land and building? It was, we said that it was 47. Much plant, where did I calculate? So total 47 was there in the beginning. But then I charged some depreciation. So this is 2825. So it is 47 million minus 2825. Okay. Okay. Let me not call it 2825. I will show you separately. Actually, you should not be showing it separately. Just for the sake of doing it, I will show you separately. I will say, I will take this number 2600. So 47 million minus 2600. Your investment property, which you converted into into land and building, 6 million minus 225. And your plant and machinery, which is 24 million minus 3 million. So these are the three numbers you should be actually taking to your balance sheet. And by the way, I just, for the sake of clarity, I mean, simplification to make you understand, I put them like this. The total is actually now 71.1. This is my total non-current assets. This I should not call it investment property anymore. This is not investment property. It has already changed into land and building, because investment property is land and building. So it might be a building. So it is already under this heading. But I'm just, for the sake of simplicity, I'm showing you separately that investment property, which is now land and building. Okay. So these numbers you should take. What else is there? You should make a calculation for your taxation. Okay. The last note, we call it working number 4, which is for my tax. So I know that if I have to make a calculation for tax, where should you start for the tax thing? You have your current year tax, which is 2.4 million provision. The question says that a provision of 2.4 million is required for income tax on the profit for the current year. Very well, we understand. Then if we go back to the trial balance, in trial balance, we had some tax under our provision shown here. It is on the credit side, 1.1 million. What do I do with that? It is over provision. I will call it over provision from last year, because it is shown on the credit side. I should subtract it. And then I would say movement on deferred tax. So how much is deferred tax? Let's find out deferred tax. So deferred tax, how much is the opening balance? The opening balance on the deferred tax is 2.5 million. So if I take this deferred tax, my opening balance is 2.5 million, which is a liability. And then what happens that I've got here current year period deferred tax is 10 million. It says that taxable temporary differences of 10 million as at 30th September 2005. 10 million. Okay. So this you have to pay, plus you make a revaluation. So deferred tax on PPE revaluation, which is 32 million. 32 million into 20%. And this comes in equals to sign. Then I have my deferred tax on other temporary differences. It is given in the question that for other temporary differences, you have 10 million. So that I also put as 10 million into 20%. Temporary differences are 10 million. So it makes me 2 million here. Now these are this number. So let me put this number as, these are for previous year 2.5. Let me just calculate the current year. I need to put change the signs here, because that is going to create my liability here. So this is my last year. I make it minus. And if I make a total, my deferred tax is 59. This is the difference, okay? I would call it movement. That last year it was 2.5. So how do you find out the difference? The movement is this year minus last year. So my this year deferred tax is these two numbers. And if I subtract the last year, it means that deferred tax has increased by 5.9 million. So 5.9 million is the deferred tax increase in liability. But remember that the property, the deferred tax on the property does not go there into your tax expense. In your tax expense, you don't show it that. So we should subtract this thing. In a total liability, it is 5.9. When you will make the balance sheet, you will write down deferred tax 5.9 million. But when you have to put the income tax expense in the income statement for the year, this 64 should not be included, because this is not expense for the year. This is for the future periods when you will sell the property. So we would say that deferred tax due to property revaluation. This question, this topic I have discussed many times in, how to say, IS 12 MCQs while doing. So we say deferred tax. So actually your tax expense should come into your financials as minus 500. This is what I'm going to show as my tax movement here. This is actually your what should go to your profit and loss account, what should go to your P&L. If you are not clear about until, please ask me. Listen, my total deferred tax liability is 5.9 million. There is no doubt about that. In the balance sheet, I will show 5.9. Last year, I was showing 2.5. This year, I will show 5.9. This is what has increased. But at the same time, what you should understand that if you talk about the tax expense in the current year, because tax expense in the income statement, you will only show 500 minus, which means that it is even not the expense, because this 64 is actually on property, and property revaluation deferred tax does not relate to only 1 year. Income statement for, we just subtract it from there. If you are clear on that, I can start making our income statement the calculation.
Yes, it's clear, sir.
Okay. So we come back here, we say that here we started. Okay, so let me just take it further above, and then we have to show what in income statement, what else adjustment we need to give. We add back our gain on sale of investment property, which was 2 million, if you remember that 2 million. Then we will say that revaluation of PPE, we need to show that part which is on investment property, right? Revaluation of investment property, which is 1 million, that I should be adding. Then we have, because they told us in the question that depreciation was not charged to this thing, because it says that question says no depreciation has been charged. So what is the total depreciation? If we see, consider the total depreciation, I did not make a total. Actually, I should have made a total for that, but no problem. One depreciation is this one, 2600. This is on building. One depreciation is this one, which is on that transfer PPE. And one depreciation is on this one, which is on your plant and machinery. 2600, 225, and 3000. So 2600, 225 plus 3000. This is our depreciation. We did not charge it before, okay? So minus 2600, minus 225, minus 3000. This is going to decrease my retained earnings. Then we have our income tax expense. And that income tax expense is minus 500. This one. This goes to P&L. Tax expense to P&L, okay? We come back. Okay, that's all. Is there anything else left if I've forgotten something?
So the tax expense of the year.
Tax expense for the year, I have adjusted it in here. That 2.54 million which you said, I included it here. Current tax provision. This one you are saying?
Yes.
No, but I've actually taken it here. Okay. Yeah, sorry. I'm sorry. I should take this as tax expense of the year. Tax expense of the year. I'm sorry. This is actually, this 500 will come in here and 800 will go there. I'm sorry. This 800 is your tax expense. So it should be here like this, minus 800. Tax expense, because this schedule was not tax. This number will go to here, and then together we will make it 800. So 800 is the tax expense. And when we make a total of that, it gives us 12,065. This is, we call it adjusted profit for the year. Adjusted retained earning, not profit, retained earning. Okay. If you have any questions, please ask me. Low notes. Okay, that's all. Low notes, we have added 1 million. That's all. This is your first part, part A, which was for calculating your adjusted profit. Now, when we will make the second part, it says, actually you would see that, okay, 8 marks and we spent quite a lot of time, but actually these wordings will help you in doing the second part as well. Part B, it says that prepare the statement of financial position of Candy Company as at 30th September 2005. So these are the numbers which you already have calculated. So it took you more time in making part A calculations, but the support workings which you use in part A, these we are going to use in part B. So it will help us, okay? So if we have to make our balance sheet now, I'll just take this format here a little down so that we don't have to scroll again and again. So I put it here and I will say that statement of financial position, okay, of Candy Company as at 31st September 2005. And we say here what I've been given. I'll just start writing the format in which they have given us, okay? Retained earnings, loan notes, investment property, land and building, and then you've got plant and equipment and accumulated depreciation. Oh, sorry, plant and equipment. Oh, this is the trial balance. I'm sorry. What I'm doing. And you guys also do not tell me that. So what are you doing? You've got here non-current assets. Within non-current assets, we will start writing down. So now we have to prepare the balance sheet format. Okay, this is the thing which is given, is my, how to say, trial balance. So I've got here under non-current assets, my PPE is there, and actually all three of them are PPE now. I don't have any investment property anymore because two investment property, one was sold, other was converted. And within PPE, I will have my land and building and my plant and machinery at the book values. Okay. Then I have my here current assets. And there is only one line for current assets, so you don't have many current assets. And this you will call total assets. That would be simple. Second part, side of the balance, second, equity and liabilities. And in equity and liabilities, you will have your equity, not equity shares. Let me just call it share capital. I will call it my retained earnings. Then I have my non-current liabilities. And then I will have my current liabilities. That's all. Non-current liabilities, current liabilities. So what are my current non-current assets now? Non-current assets, if we consider, we just made a total of 7115. These numbers 3. You can show them in working, or it is, I would just say here like this. I'll take this up and I'll take it to this one. And I would say, what is the name of this working? This is working number 3. Okay, I would call it working 3. So if somebody wants to see, they can see that where it is coming from. Current assets, there was no adjustment as such. I think current assets are 68,700. I'll just take them like this. It is given in the trial balance, and there is no adjustment about that. So I just took it 768,700. And this number also should not be put. And I make a total. And these are my total assets, 139 point something, whatever it is. And just make it like this. Okay. And share capital, there is no change. I would just say as per trial balance, TB. What is that? Share capital was 20,000. Retained earnings, as per working 1 or whatever it is. We calculated our retained earnings on the top, 12,065. Non-current liabilities, loan notes working. Where is the non-current liability? Loan note we calculated. This 29,810, working 2 or whatever. You can call it working 2. This is my loan note. I've got only one non-current liability. This non-current liability. And then if I speak about the current liabilities, that will go from your financials, trial balance, 43,400 they have given us. So current liability, 43,400. I'm going to make a total, it will not become equal, and then we will discuss why it will not be equal. What is missing? I'll keep some space, 105. If I see the difference, this is the difference between two, and I'll call it total equity and liability. Now you guys will tell me where the difference is coming from. Yes, please. Which items were missing? This is very important. This is what happens in exam, that you get numbers which are not equal. And then you have
So did we miss the suspense account adjustment?
No, that is not the answer. Suspense account adjustment, what do you want to make adjustment to that?
So there was some non-current asset sale, which is on the credit, and we have cash on the debit side of the suspense account.
So it is included in your current assets.
So why it's giving in the note 2?
No, I don't understand.
So the suspense account is the adjustment is given in the note 2, the details and information.
Sir, I think we had deferred tax too.
Yes, we have deferred tax as well. That's fine. Under non-current liability.
Yeah, that's missing.
So how much is the deferred tax?
We calculated it on working.
Total is 64 and 2,000. These two numbers. Yeah, 84. 84. I can put here deferred tax 84. Then what else is missing?
Valuation is missing.
So when you are doing it, you should see what is the difference. If the difference comes in very small numbers, you understand it is in current assets, current liabilities somewhere. It's a big difference. It's a 26 million difference. Yeah. Think about big numbers. I think that we forgot about the revaluation surplus. So how much was the revaluation surplus we need to put back? Yeah. How much is your revaluation surplus? Can you tell me now?
Yes, sir. Can you go a little bit above?
Yeah, please. I can. 32 million you calculated revaluation surplus here.
Yes.
Then you had 1 million, 2 million on that. Remember this thing? Gain or something. Revaluation, no, that was on gain. So you made a revaluation surplus of 32 million. But then what happened? You had some deferred tax on revaluation surplus as well.
Yes, we must
so
subtract
your net revaluation surplus is 32 million minus the 64 because you have to pay tax on that. So when you make your revaluation surplus, 32 million you made minus the deferred tax on that, which means 32 million into 20%. So you should always speak about net of tax here. So that makes me, now I've got difference of only 600. Where is that difference coming from? 600. Now it's a small difference. And still it is on this side. This side there is something wrong. So this is current tax expense for the year 800. This is your tax liability. You will make debit tax expense, credit tax payable. So this is your current tax liability, and it should come here. Now you've got 200 more on this side. So what appears here now? Do we have any number mistaken here? Assets are quite clear. I think assets are correct. We did them very carefully. What were the assets? 68,700. Yeah. Let me see the numbers if we made some typing mistake. 25,000 is okay. Then I've got my retained earnings, 12,065. We calculate from above. I will check it there. Revaluation surplus is 30,000, 32. Okay. Non-current liability, loan note, it is correct. Deferred tax 84 is correct. So this we did it once. This we are very much careful. Current liability we are taking from the trial balance. This is okay. Straight away. Revaluation surplus is straight away. Share capital is okay. So the only issue could be in retained earning and in this one. Let me go back to the retained earning thing. Retained earning 15,500 we are taking. Is it 15,500 the starting point? Yeah, 15,500. So 15,500 was there. We add back 100 loan notes expense adjustment 810. I took from here. Okay, that is fine. 1,029. Okay. Gain on sale of investment property 2,000. Gain on this is this one. Depreciation I took this 5825. Let me see what was the depreciation. 26 to 25 and 3,000. Depreciation 2,600. 26 to 25 and 3,000. So I took it here 26 to 25 and 300. Yeah, 2,600 to 25 and 300. 5825. Income tax expenses 800. 12,065. 12,065. Okay. Apparently it seems all okay. Current tax liability. We are making some mistakes somewhere else. I got the mistake. Actually, our current tax liability, as per the question, they said that the current tax liability is calculated as 2400. We started here. So current tax is 2400. So this is actually, we should put it here as 2400. If I put as 2400, it becomes 1800 difference. And I remember that number 1800, where it is coming from. Number 1800 is in my memory. Now, this is something which they did not tell it very clearly. This was 1.8 million. This was the loan note interest. What we did, we actually charged into our loan note. If you remember the loan note adjustment, we made only 810. Okay, because what we assumed that total loan note expense is 26,100. They already have recorded 1800 and 810 further we charged here. But it looks like that 1800 is also not recorded, because if we read it here, actually it does not tell us clearly. It says that the loan note was issued on this date and incurred issue cost of 1. The interest of 1.8 million was paid on 30th September 2005. The loan is redeemable on 30th September 2009 at a substantial premium. No other repayments are due. So actually, it is not very clear, but it is assumed that this 1.8 million has not been, how to say, paid out yet. It has not been recorded in your adjusted profit. So if we just charge this number with this number, total 2610 interest expense into -1. So our profit retained earning will become 10,0265. Instead of charging the difference, the full 2610 should be recorded. Your retained earning will become 10,265. And now if you scroll down, it should
Yes, now it's correct, sir.
now it is equal. Now there is no difference. So the only difference was in loan notes. And because of loan note, that 1.8 million, it becomes 10,265. Okay, finally it is done.
But what is the
Then comes this part C, which is actually rather simple. Let me do it here. Part C, it says that prepare the extracts from Candy Company statement of cash flows for operating and investing activities for the year ended 30th September 2005. So first is operating activities. So within operating activities, you only need to think about the adjustments which you have to make. So if you remember in operating cash flows, we say add back depreciation, add back investment income, anyone if you have there. So whatever is my operating cash flow, I will add back my depreciation. And depreciation was actually, if I'm not mistaken, it was 5825, the 3 depreciations. So add back depreciation of 5825. Numbers were 5825, yeah, I think 5825. This is the number we should add back into your PBIT, profit before taxation. And then you have some gain on disposal and gain on revaluation. You have gain on disposal. You remember we made a gain on disposal, which was 2 million, 15 million property we sold for 2 million. And there was a gain on revaluation. This was on investment property of 1 million. So this 2 should be subtracted. That's all. This is pretty simple. So your operating cash flow will be adjusted by 2.825 million. If you think about like investing activities, even here, what happened that in investing activities, you will add proceeds from sale of investment property. Remember, we sold the investment property. How much we sold it for? 17 million. That's all. So in profit and loss account, this 2 million, because when you make your P&L, in your P&L, you record it as other income. When you sold the asset, you got money, you put it as other income, 2 million. But so you adjust for 2 million, you decrease your cash flow because that's not operating cash flow. You received the cash, 17 million, but 2 million was put in other income, so we add back. I'm sorry, we subtract it from there. In cash flow statement, in investing activities, whatever cash you have received actually by selling the asset, you show. So 17 million we have received, so we put 17 million here. That's all. This is only for your part C. That's for 3 marks. Maybe 2 marks they will give here, maybe 1 mark they will give here. Clear?
Yes, sir. Clear.
the tax base?
Okay, you asked 3 things. You said taxable. Now you are just asking some question. Taxable temporary differences. And then you said tax base. Okay, so taxable temporary differences, actually this is, so there are temporary differences on which you calculate deferred tax asset or deferred tax liability. Taxable temporary differences means that you have, that it is deferred tax liability. When any valuation, the differences in valuation will result in liability. So those temporary differences which will create your deferred tax liability, those differences are called taxable temporary differences. I will give you example, wait for a while. Then you say tax base. Tax base is the value of asset in the books of the tax department. You have 2 values of asset, okay? You call it the carrying value of asset. I say carrying value of asset, or I say tax base of an asset, let's suppose, the tax base of an asset. So in your books, this is your IFRS thing, and this is your tax thing. So in your books, let's suppose you show an asset for $100,000, but for the tax department, it is for $80,000. So this is the difference between the tax base and the difference between the carrying value. How much is the difference? 20,000. Let's suppose your tax rate is 20%. So it means that deferred tax asset or deferred tax liability would be 4,000. As a result of these 2 numbers, the deferred tax asset or liability, I will speak what it will be, whatever it will be, but deferred tax will be 4,000. Now the question is that will it be a 4,000 deferred tax asset or will it be 4,000 deferred tax liability? Now remember, in your books, IFRS books, you are putting higher asset. When you put more asset, it means that you are charging more depreciation. When you are charging more depreciation, it means that you are calculating less profit, and less profit means less tax. So it looks like that by putting asset higher value, you are paying less taxes now. So if you are paying less taxes now, you will have to pay this tax in the future. So this is your deferred tax liability. And this is called taxable temporary difference. So you've got a taxable temporary difference of 20,000 because as a result of this 20,000, you will have to pay 4,000 sometime later in the years. Am I clear?
Yes, sir.
If your tax base becomes more, let's suppose that your tax base is not 80, but it is tax base is 125,000, but you have IFRS only 100,000. So now it is not taxable temporary difference. It is not taxable. It is deductible temporary difference now. Deductible means that it will give me 5,000 deferred tax asset. Because what is happening if I make like this? My tax department has 125. I have only 100. It means I'm charging less depreciation. Less depreciation means more profit. More profit means more tax. So it means I'm paying more taxes now, and in future I will recover. In future I will pay less. So as a result of this scenario, whatever is the difference is 25,000, and that 25,000 will give rise to 5,000 of deferred tax liability. So this 25,000 is now I'm calling it deductible temporary difference. If it is 80,000, I will call it taxable temporary difference. Okay. So you would understand that whenever your carrying value is more, your book value is more, you will always end up with deferred tax liability.
Okay, sir.